Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar continues to surprise. Stock indices are selling the facts. Gold is taking on the role of a hedge against inflation, and Bitcoin is losing to everyone. The US dollar has recovered thanks to the Fed chair's reluctance to signal a rate cut in October, a correction in stock indices, and rising geopolitical risks. Each of the USD's main competitors has its own Achilles heel. The euro is disappointed by Friedrich Merz's fiscal stimulus measures. The leadership battle in the Liberal Democratic Party weighs down the yen. The pound is concerned about the Treasury's ability to plug a £35 billion hole in the budget. Scott Bessent expressed surprise that Jerome Powell did not signal further rate cuts in October. According to the Treasury Secretary, the federal funds rate should fall by 100 to 150 basis points before the end of 2025. However, many FOMC members are concerned about the possibility of accelerating inflation. The split within the Fed is playing into the hands of the U.S. currency. The greenback continues to act as a safe haven asset, and the United States is a net exporter of energy commodities. Therefore, rising oil prices amid increasing geopolitical risks have provided support for the USD index. The fall in U.S. stock indices resembles a sell the fact after a large-scale buy rumor after the Fed has lowered its rate. After the S&P 500 rose on news of Oracle and NVIDIA's deals with OpenAI, asset managers bought $58 billion worth of U.S. stocks. This is the largest inflow since the beginning of the year. This seems logical against the backdrop of numerous record highs for the broad stock index. As soon as the S&P 500 took a step back, the bulls became nervous. Jerome Powell contributed to the pullback. The Fed chairman said that U.S. stocks are overvalued. Until then, the markets had not attached any significance to the price-to-earnings ratio, rising to 22.9. The broad stock index has only traded above this level twice this century, during the dot-com crisis and the pandemic. Bank of America notes that 19 out of 20 fundamental valuation metrics for the S&P 500 indicate that the market is overheated. However, corporations' current positions look much better than in the past, so the current valuations may be justified. This gives investors the opportunity to use the good old strategy of buying on dips. Gold is trading near record highs, and pullbacks are attracting new buyers. Two key drivers are behind the gold rally: a change in the Fed's outlook and geopolitics. Jerome Powell emphasizes that, given the bilateral risks, the central bank cannot take a risk-free path. It must choose between supporting the cooling labor market and controlling inflation. The Fed prefers the former. Gold is considered a hedge against inflation. However, the Fed is the main defender against price increases. It raises rates as prices rise. In such conditions, gold falls more often than it rises. However, when the central bank washes its hands of the matter, gold spreads its wings. This was the case in 1979, when it jumped 140% due to lower rates against a background of high inflation. The same thing is happening now. Donald Trump has abandoned the idea of quickly ending the armed conflict in Ukraine. This is leading to a bipolar world, intensifying the processes of de-dollarization and diversification of gold and foreign exchange reserves, which is adding fuel to the fire of the gold rally. Bitcoin is losing out to all its competitors. Some choose Ether due to its higher volatility. Some choose stocks because of artificial intelligence. Many prefer USD amid renewed interest in the greenback and trying to buy low, or gold after its 44% rally so far this year. The shares of companies that bought Bitcoin are falling sharply in price, which is a signal of potential demand problems. Speculators exiting long positions are accelerating the decline in Bitcoin. Kaiko doubts that Bitcoin's turnover accounts for 68% of the total crypto market volume, suggesting that this figure is closer to 18%. Many trades use leverage, which inflates the scale of operations. Don't fight the Fed. The central bank has made it clear that it will closely monitor the labor market situation. It prefers unemployment to inflation, and investors should do the same. In this regard, the U.S. employment report for September is logically becoming the key event of the week leading up to October 3rd. After non-farm payrolls slowed from more than 100,000 in January-March to 29,000 in June-August, the Fed reasonably lowered the federal funds rate. However, FOMC members are divided on its future. The median forecast suggests a drop from 4.25% to 3.75% by the end of the year. 7 officials do not see any further reduction in the cost of borrowing, while 2 see the need for only 1 reduction. The split within the Fed is forcing investors to look in one direction: the data. First and foremost, labor market statistics. If the market continues to cool, the FOMC's September forecast will come true, and the dollar and treasury yields will fall. On the other hand, a pleasant surprise from non-farm payrolls could support the greenback. Follow the updates on global markets in Pro News Weekly. Like, share, and subscribe.